Hey, this is Max. Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every video, I break down one stock in detail, from business model to financial metrics. If this sounds interesting, definitely subscribe to the channel. There are many exciting analyses ahead. When it comes to dividend reliability, Johnson & Johnson is one of the first names that comes to mind. This isn't just a healthcare giant, it's a dividend king with over 60 years of continuous payout growth. Few companies in the world can match such a track record. In this deep dive, I'll put J&J through the secret Max Dividends 5-pillar formula, the same simple checklist I use to identify enterprises capable of growing sales, protecting profits, maintaining strong balance sheets, and raising dividends decade after decade. Today we'll reveal what exactly makes J&J such a reliable dividend income generator, whether to buy the stock now, and how this company can fit into a long-term passive income building strategy. How this company makes money. Let's start with the foundation. Do I clearly understand how Johnson & Johnson generates revenue? J&J makes money from products and services that relate to basic human needs. Whether it's medicines, medical devices, or everyday consumer goods, the company focuses on what people need regardless of economic cycles. Pharmaceuticals comprise the main part of the business. Drugs against cancer, immune disorders, rare diseases, and other serious conditions. After development and approval, these medications often become treatment standards for years, ensuring predictable revenues. Medical devices include surgical equipment, orthopedic implants, diagnostic systems, and other tools that hospitals use daily. After implementation, medical facilities usually remain loyal to suppliers for long periods. Consumer products. This is where everyone knows J&J. Tylenol for pain, Band-Aid for wounds, Listerine for oral hygiene, Johnson's Baby Cosmetics. These brands have earned family trust worldwide for generations. The beauty of this model lies in revenue diversification. No single segment can destroy the company, and demand is global and recurring. People need medications, medical care, and basic hygiene products, regardless of economic conditions. Max Dividends approach in action. Our philosophy is simple. We stick with solid, sustainable enterprises that raise dividends year after year. The longer you own such stocks, the more passive income accumulates, steadily, predictably, and without the need for active management. Step 1. Dividend history. Our basic filter, companies with more than 15 years of continuous dividend growth history. Johnson & Johnson has paid dividends for over 80 years and raised them for 62 consecutive years. This makes the company not just a dividend aristocrat, but a true dividend king, an elite group with 50-plus years of continuous increases. Step 2. Secret 5-pillar formula sales growth, foundation of strong business. Over the past decade, J&J's revenue grew from $70 billion in 2015 to nearly $89 billion in 2024. The driving force is the pharmaceutical division. Medical devices add stability, and consumer brands provide a reliable baseline of revenues. Sales growth past. Sustainable global demand for medicines and medical equipment supports revenue growth year after year. Profit growth. Fuel for dividend growth. Johnson & Johnson's operating profits developed steadily alongside sales. Operating income increased from approximately $48 billion in 2015 to over $61 billion in 2024, despite spinning off the consumer products division. Profit growth past. Profitability is solid, stable, and well supported by J&J's diversified healthcare portfolio. Net income, true measure of strength. Johnson & Johnson's net income remains strong and reliable. Even through the COVID pandemic and inflationary shocks, J&J continued generating billions in profit annually. This resilience is exactly what dividend investors value. Net income past. J&J demonstrates its resilience with stable profits through all market cycles. Dividend payout safety, protecting passive income. Johnson & Johnson maintains conservative dividend payouts. The trailing 12-month payout ratio is around 55%, with the 5-year average close to 60%. This is a conservative level for such a stable company. J&J's business stability makes this payout level safe. Even during downturns, people still need medications, surgical procedures, and health products. Dividend payout safety past. sustainable payouts backed by durable cash flows, and decades of proof that dividends come first. Debt burden. Avoiding financial traps. Johnson & Johnson has debt obligations, but they are quite manageable relative to the company's size and cash generation. The debt-to-equity ratio is around 0.6, significantly below risky levels. Debt burden past, conservative leverage, excellent balance sheet strength, and virtually no financial red flags. Company's financial condition. According to our evaluation system, Johnson & Johnson receives a financial rating of 90 plus out of 99 possible points, the highest assessment for long-term investments. Such a score signals that the company is fundamentally sound and designed for long-term perspective. According to the secret Max Dividend's 5-pillar formula, J&J is classified as a reliable dividend king. Impressive history, reasonable payout policy, and significant safety margin for future development. Does it fit my plan? With a max ratio of 4.67, dividend yield of 2.8%, and average annual dividend growth of 6%, Johnson & Johnson falls precisely into the balanced eagles category. This means the stock works in two directions: moderate capital growth plus stable dividend growth. It may not be the flashiest stock in the portfolio, but it's that reliable compounder that strengthens the foundation of any dividend portfolio. Is the stock undervalued today? By all our key metrics, J&J looks attractively valued, cheaper than competitors. According to the Max Dividends app, J&J demonstrates undervaluation compared to peers in the healthcare sector, cheaper than its own history. Over the past 10 years, J&J usually traded at a PE around 22. Today it's closer to 20. Indicating slight undervaluation. Better yield than usual. Current dividend yield is 2.76% versus a 10-year average of 2.72%. Investors are getting slightly more income than usual. Analyst consensus shows slight caution. J&J trades around $188 per share with average analyst price target of approximately $184, implying potential 2% decline in the near term. Final decision. Johnson & Johnson is a fantastic example of the type of business we seek at Max Dividends. Strong balance of capital growth and dividends in one package. However, under current market conditions, the pace of dividend growth over the past 10 years, together with current yield, leaves limited room for starting new investments. Nevertheless, this is an excellent company, a true dividend eagle meeting all Max Dividends quality standards, and an excellent choice for balanced dividend portfolios. The same methodology I applied to J&J works for any stock. And the best part, everything is already integrated into the Max Dividends app. Financial ratings, max ratio, lists of top dividend eagles. If this analysis was helpful, support with a like and subscribe to Max Dividends. Remember, this is not investment advice. See you in the next analysis.